Everybody loves dividends. You own the right company and you do nothing, and then this company keeps sending you checks. But now that companies are cutting dividends, is there something that you can do to capitalize on this dividend crash? What's up everybody, I am Jaspreet Singh and welcome to the Minority Mindset. Dividends are passive income checks you can get as an investor just for investing in a profitable company. This is something anybody can do. So if you have a couple $100 and you go out and you buy one share of the McDonald's company, the McDonald's stock, you become one of the owners of McDonald's, and now every 3 months or every quarter, McDonald's will send you a check just for investing in them. Well, ever since this great lockdown started, the economy has been shut down and now people are worried about a recession, and so companies like Dick's Sporting Goods, Ford, Delta, Marriott, and Carnival have led the way by either cutting or suspending their dividends. So if you were planning on living off of your dividend checks this year, you might have to hold off on the extra guac. Dozens of major companies have already cut or stopped their dividends completely, and you can expect more companies to cut their dividends over the coming months, which is bad news, but there's also opportunity in this too. That's why in this video, I want to talk about what dividends are and what these dividend cuts mean. So make sure you watch this video until the end, because in the end of this video, I'm going to be talking about how you could potentially capitalize on these dividend cuts. But before we get into that, hit that thumbs up button below, because if you don't, then YouTube doesn't share our video with anybody else. Subscribe to the Minority Mindset YouTube channel. That way you don't miss our new financial education videos every single week. And hit that little notification bell too, because if you don't, then YouTube doesn't let you know when the new videos are released. Like I said earlier, dividends are passive income checks that you get for investing in a profitable company, and the amount of money you make depends on how many shares of this company you own. Like if you just own one share of the McDonald's company, you're not gonna make $1 million. You might get enough money to buy a couple McFlurries. The more shares you invest in, the more McFlurries you can get. You can also use your dividends to pay down your mortgage or buy something nice, or you can reinvest your dividends to buy back more shares of the company you invested in. That way you can compound your wealth, because now you're reinvesting your profits to grow your wealth quicker. At the end of a year, a profitable company is gonna have extra cash in their bank account after paying for all their expenses, and there's a few things that they can do with their cash. They can save this money for emergencies, they can invest this money back into their company, or they can give this money to their owners. A strong and established company should do all three. You should always have money saved for emergencies. I mean, 2020 is a prime example of why. You always want to be investing back into your company, and you should reward your owners for making a good investment. One way you can reward your owners is just by giving them cash. I mean, don't you like it when your grandma sends you that birthday card in the mail with $20 inside? Your grandma gives you dividends? Not exactly. You don't own shares of your grandma. When you invest in a company on the stock market, you become one of the owners of that company. Like I said before, if you go out and you buy just one share of the McDonald's company, you become one of the owners of McDonald's. So now when McDonald's has this extra cash in their bank account and they send these dividend checks out to their owners, you get one too. The great part is you don't need a ton of money to start. Like, you can start investing in stocks with as little as $100. But not every company pays a dividend. You will rarely see your startup companies, called growth companies, pay dividends, because these startups are spending every dollar they have and some by going into debt and getting investments back into their company. This way they can grow as fast as possible. So these are your companies like Uber, Lyft, Beyond Meat, Peloton. Their goal is just to grow the company and be worth more money. That way they can get a higher stock price. Their goal is not to start sending checks out to their owners, at least not yet. I love investing in real estate because of the passive income you can get. And that's why I also like dividends, because you can get paid without having to sell your stocks. If you buy a stock for $100 and then the stock goes up in value to $200 a share, well, it looks like you just doubled your money, but you don't actually get any of that money unless you sell some of your stock. And if you sell your stock, now you no longer own the stock or have ownership in this company. Versus if you have a dividend, you can still get paid without having to sell your stock. Like Warren Buffett's company, Berkshire Hathaway, made $640 million in dividends just from their investment in the Coke company in 2019. That's $72,000 an hour, 24 hours a day, 7 days a week, for doing nothing besides owning the right company. Obviously, he owns a ton of shares, But if you keep investing a little bit of money each and every month, you can build your own regular stream of income through dividends. You should understand though that some companies pay bigger dividends than others. Like REITs, real estate investment trusts, are known for their higher dividends. REITs are companies that invest in real estate. So when you invest in a REIT, you're investing in a company that's investing in real estate, and by law, REITs are required to pay back 90% of their rental income back to their shareholders, you, through dividends. That's why their dividends tend to be higher. To see if a company is paying a dividend or not, all you have to do is go to your stockbroker or go to any stock news website and then enter in which company you want to look at, and over there it should say something like dividend or forward dividend yield, and if there's a number there, like how this is 5, that means that this company is going to pay you $5 per share that you own every single year. And if there's no number there, that means this company is not paying you a dividend. So if you own 1 share, you get $5. If you own 100 shares, you get $500. And if you own 1,000 shares, you get $5,000 a year, unless your dividend gets cut. When the economy slows down, like we're seeing happen right now, companies get worried about having less money in their bank account at the end of the year to send you your cash checks. By the way, they usually don't send you a physical check. They usually just deposit this money into your brokerage account. Plus, if the economy is slowing, a company is probably going to want to have more cash on hand. That way they can protect themselves from an emergency instead of just sending all this money out to the owners, at least for now. What you want to know is if and when the dividends are going to come back, because this can create a huge buying opportunity for you, which I'll talk about in just a second. But if you do want to invest in companies on the stock market, you have to use a stockbroker. And thanks to our sponsor Webull, that's very easy to do. And I got their link in the description below. Webull is a commission-free broker, so they don't charge you a penny to make a trade. That way you can use your money to invest instead of using your money to make your broker richer. Not even 1 penny. All you have to do is open up a free account, fund it, and then you can invest in whatever companies you want. And if you want to invest in dividend-paying companies, you can do that too. Plus, you can research companies and see if they pay dividends right on their app. The best part is that right now, at the time of me recording this video, Webull has a limited time promotion going on where they are giving Minority Mindset fans 2 free stocks just for investing with them. So if you want to learn more and see how you can get your free stocks, I got the link to how you can do that in the description below. Minority Mindset is a partner with Webull, so if you use them, we will get compensated, but there's no additional cost to you. I mean, it's free to open an account, and they don't charge you a penny to make a trade. So if you want to learn more and see how you can get your free stocks, I got the link to how you can do that in the description below. Every crisis comes with opportunities if you know where to look. Now, before I get into actual investing strategies, I should remind you that investing has risks. You are never guaranteed to make money when you invest. You might even lose money. So always, always, always do your own due diligence and don't just blindly listen to a random guy on YouTube. When the 2008 recession happened, the entire economy was hurt. Like the car market tanked, the real estate market collapsed, the stock market was hurt, and dividends were cut. Not my dividend! When investors hear that a dividend is being cut, this makes a stock less attractive to buy, and this generally scares investors and pushes people to want to sell the stock. Now, it doesn't always work like this, but having less dividends is less attractive to investors, and if you have more sellers than buyers, this pushes the price of a company down. But what we saw was that these dividend cuts weren't permanent. It took a few years, but strong companies recovered and their dividends came back stronger than ever. Like if we look at this dividend chart, you'll see that in 2008, companies started cutting their dividends. And so dividends tanked in 2008 and 2009. And by 2012, 2013, the dividends had returned to normal, and then the dividends kept going up after that as companies made more money. The people that invested in strong dividend companies during this 2008 crash came out huge winners because not only did they get to buy a strong company on sale, but their dividends grew at an insane rate. Let me show you what I mean. Let's say you buy 1 share of a company that's selling for $100 a share right now, and this company is paying a dividend of $5 a year, which is a 5% return on your money. So you buy 1 share of this company, and let's say over the years, the price of this company, the stock price goes up to $150 a share because they're making more money. Well, now because they're making more money, they decide to raise their dividend to $7.50 a share. That's still only a 5% return on your money based on their current share price, but you bought this stock for $100 a share, not $150 a share. So now when you get your $7.50, you're actually getting a 7.5% return on your money because you bought the stock on sale and your dividend just got a raise. So if you invest in a company and the dividends go up, your income goes up too. Plus, when a company raises dividends, this generally makes the stock more attractive, which could drive more buyers, which would drive the price of the stock higher. When you have more buyers than sellers, this pushes the price of the stock higher. The key is to find a strong dividend-paying company that's distressed but has cash on hand that they can use to recover. That way, when the economy starts to grow again, this company will be able to go up and you will be able to win 2 times, 1 with the stock price and 2, hopefully, with the dividend growth. Does it always work like this? No! That's why investing has risks, and that's why you need to always do your own research. I mean, this time could be completely different. As a quick tip, you don't want to invest in a company just because of the size of their dividend alone. That can be very misleading. Look at a company first and their dividend second. Like if we go back to our previous example where there's a company that's selling for $100 a share that's paying a $5 annual dividend, well, if something's wrong with this company and its share price drops all the way down to $30 a share and they haven't cut their dividend yet, well, now that dividend looks really attractive because you're getting a 16% return on your money. But maybe this company is on the verge of bankruptcy or they're having real underlying issues. That's why you need to study the company first and the dividend second. And if you don't know how to analyze the company, then you might want to consider looking into a high yield dividend index fund or ETF. These high yield dividend index funds are essentially a big group of companies that pay dividends. So now instead of you trying to go out and find the perfect company to invest in, this fund will have a bunch of dividend-paying companies, and when you invest into this fund, you get a little bit of exposure to a bunch of different dividend-paying companies. The good news is now you don't have to worry about trying to find the perfect company to invest in, because if you invest in the wrong company and they go bankrupt or they just get rid of the dividends completely forever, you're still okay because now you will have exposure to a bunch of different dividend-paying companies. The bad news is your dividends tend to be averaged out because some of the companies in your fund might see huge dividend growth while others don't, so the amount of dividends you get are averaged. We don't know how long this economic crisis is gonna last. Like the average bear market or downward stock market lasts somewhere between 12 to 18 months, and after the 2008 crash, it took about 4 years for dividends to return to normal. And I don't need to tell you that there's a whole lot of uncertainty ahead in our economy because we've never seen a pandemic like this before. That's why it is so important for you to stay on top of what's happening in the finance and business world. That way you can make the smartest decisions with your money. And if you're looking for an easy way to do that, well, that's why we created the free Minority Mindset newsletter, where our team first breaks down the top finance and business news, and then we show you how this news affects your wallet. That way you can be smart with your money. And then our team will email you this newsletter every Monday through Friday at 7:30 a.m. Eastern Standard Time, and you can read the newsletter in less than 5 minutes. If you want to start getting a newsletter for free, you can do that by clicking the link up here or by clicking the link in the description below. By the way, our financial news emails are different from our financial education emails. Thank you for watching. If you enjoyed this video, share it with one friend. That way we can help spread the word. If you want to learn more about a potential real estate crash that might be brewing, I already made a video on it, and you can watch this video on YouTube by clicking this button right over here. Thank you for watching, and as always, keep hustling.